Can you hear me?
Yes, we can.
Okay, good. So I got a question from your colleague Otabek, correct?
Yeah.
And I guess that everyone is interested in this question. So regarding the exam, one mark. Before I tell you what is fair or what I want to do, can you tell me, please, your opinion about what in Europe, what you think that should be the exam, how the exam should be conducted, the final evaluation should be conducted. So, for example, Anton, how you would like to be evaluated?
Of course.
How?
How?
Yes, which way?
In other disciplines, we have formula. For example, exam weights about a half of result mark. Homeworks weight about 5%, and tests about 15 or 20%.
Anton, it's not 100 that.
What?
It's not 100.
Yes, because I said you an example of weights of different elements.
Yes, but the sum of weights should be 100.
Okay, I can say that we can have two tests, which weights for 20% each, exam with 50%, and two homeworks.
Okay. And then
it will be 100%.
Yeah, this is 100. Anna? The next one. Ekaterina, how do you want to be evaluated? Microphone, please. Microphone.
We can't hear you.
Switch on the microphone, Katerina.
She said that her micro that doesn't work.
Oh, okay. So, Leonid, tell me.
Excuse me, I just connected a couple of seconds ago.
Okay, Nadia?
About the mark of the course?
Yeah, how do you want to be evaluated?
Maybe 50% from a mark exam, 20% control work, and 30% is homework or activity in the class.
Okay. Yes, I would like to do something like this. So you, at the end of the course, you will get an exam, and then you will have about 2 hours to answer to exercise as well as to theoretical questions. But during the course, then you will select a topic that you like, And then you will prepare a report on this essay, and that will count 30%. And also during the classes, we have some interactions, no? And then depending on the interest that you showed, the participation, then you will get a score as well. This is what I'm thinking about. So you collect your ideas, and then, as usual, as I mentioned, you coordinate with Nadia your opinions about how the test, the exam, the final evaluation should be done, should be performed. And I sent before a link. That is the link to SSRN. Do you have it, or should I send it again?
Which link do you mean?
I do it again.
No, I mean, what link are we talking about? I mean, for what?
I sent it again the link. Can you see it?
Oh, yeah.
Okay, this is what I sent at the beginning of the class before. So there are some papers that I published or that I drafted, and then you see some that have been done by some students. For example, the first one that is the most downloaded is in Italian, and you can read just the abstract. And those two students, Filippo Regina and Pietro Luiso, did an essay on the topic on the Markowitz and so on. So this is just an example, as I said, and then there are other examples. But can you see it? Can you see the paper that I mentioned? The first one on the top.
Yeah.
Okay. So this could be an example for an essay on one of the topics that you like. You select the topic and you say that you want to work on that, and then you can work also with a colleague. So 2 people is fine. More no. So that is an example, as I said. Okay, so do you have any other question?
So we'll have to make a project based on topics of one of your articles, or I did get it wrong?
No. I said anything that you like about this class. Okay. We talk about investments. We talk about then whatever is around that. So it can be risk, can be asset allocation, can be portfolio optimization. So you decide what you like, and then you write an essay.
Okay, and what is the deadline? Or it's like in a few weeks?
I want to read. I want to get this before 10 days before the end of the course.
Okay.
And you can decide the number of pages. Can be 100, can be 1. Of course, if it's 100, maybe it's too much, and if it's 1, it's too little.
Okay.
Question? Yekaterina, next time, please try to make sure that your microphone is working. Yes. Okay.
I have a question. Yes. So this essay that we should write in pairs, how many percent of final mark it will cost?
No, it's not the cost. It's
Weight.
No. Okay. It should be 30%. Then, as I said, 50% the final exam, and then 30% this, and also the remaining would be the interaction in the classroom and so on.
Okay, thank
you. What's the methodology for evaluating our interaction in the class? Is it going to be some kind of a subjective points, or are there some objective methods?
It's subjective because, of course, if you intervene is one matter. If you don't, is completely different. No, but normally I try to involve everyone, as you have seen. I call everyone and I try to discuss each point with someone. Okay.
And
so, on that point
I've
of view,
got one more question.
On that point of view, just a second. On that point of view, unless you sleep, you should be fine, right?
So yeah, I've got one more question.
Yes.
I have no idea about this course. I mean, what it is about, and do we have some kind of a recommended literature or the syllabus to look at? Because yeah, I'm sitting in the class and don't know what I'm learning now. I'm just wasting my time.
Well, the syllabus is not complete. It's not because I got the message that I should teach this class a couple of days ago. So what I can do is to share provisional syllabus. Yes.
Will you send the syllabus?
No, I can do it right now. Just a second, because the sketch is this one. And then we will have derivatives also.
Okay, clear. Thank you.
Okay. Other questions?
Yes, again, I have one more question about essay. I don't understand how many pages or what's the size of essay?
It's up to you, really. I told you, 100 is too much, too many, and 1 is too little. You decide. Of course, I don't ask you to do to prepare a scientific paper, because that will require a lot of time. But you should show that you like the topic, and also that you understand it. And please don't copy, because then I will ask questions about what you have written, and then it will be a problem.
Okay, it's clear. Thank you.
Okay, good.
Must we write this essay only in pairs, or we may write it in groups? I don't know. What is the maximum number of participants?
I said before this, maximum 2.
Okay.
Because if you are more than 2, there is always one that doesn't do anything, or very little. Other questions? No? So let's go ahead. Share my screen. Can you see my screen?
Yes, we can.
Okay.
But the quality is too low.
Yes, this is a problem. As someone suggested, I will send you the pages that I'm showing. Well, anyhow, we said before what that there are different components. The reason why people lend money or borrow money, and then the different components of the interest rate. So now, can you see the formulas?
Yes.
Okay, this is one formula that maybe you already have seen this formula, you will tell me. So what you do to understand whether your investment was successful or not, you just check how much money you made divided how much money you invested. Is this formula clear? No?
Yeah, it's more than clear.
I think we may go through this topic faster, I think, because we talk about on the other disciplines.
Okay, let's go. So tell me, what is the problem with this formula then?
Because it doesn't pay into account that there is inflation and risk.
No.
It doesn't take into account variation.
Yeah, take into account.
No, that is not a problem. Let's have a different idea.
So we have just two fixed values, the beginning and the ending one, and we haven't got anything in between. So it should probably be more logical to consider something in between, I guess.
What do you want to do?
So for example, stock market, some indicator, I would say, for example, let's take S&P 500. It can move in some other direction during the period, and there is some kind of volatility included. And the problem with this formula, I guess, is that it just takes into account two ending points, the beginning one, the initial point value, and the ending one, and nothing in between. So it's kind of the information is limited, or I don't know if something else could be considered.
Okay, this is true, but you have other means to check that. At the end of the day, if you want to know how much money you made, this is fine. That what you said is not a problem. So what you want to see is the risk that you made that money. And to measure the risk, you don't need to put anything in the middle in that formula. So the answer is more no than yes, but you have a good point. So who else can say what is the problem about that formula?
Yeah, I've got one request. Could you please send us the slides, because it's kind of hard to memorize.
Just a second. Let me try this thing. Because it's too little, you say, no? You cannot read it. Yeah, this is a problem that we have to solve in the way that doesn't work. I wanted to share with you this screen, but it seems that it doesn't work. Let me see if I can do this. Can I send you in the chat this thing or not? Maybe because I'm not authorized, I don't know. I don't have the permissions. Let me do this way. Can you read it better?
Yes.
Okay, so who else has an idea about the problem with this formula?
There's a problem because there is no discounting in this formula, maybe. I talk about first formula.
We talked about the default before, correct? Yes or no?
Yes.
Yeah.
And we mentioned two drivers for default, no, two main drivers. Do you remember which kind of drivers we mentioned?
Time and amount.
Okay, so what you see here in this formula?
There is no time.
Exactly, there is no time. And why this is important?
Because it doesn't count for time default.
No, here we don't talk about default. I mentioned default because there we mentioned those two drivers. But now we are not talking about default, but we are trying to assess how much money we make. So why time is important in this case when we want to assess how much money we make?
Maybe because money today are more valuable than money tomorrow.
But yes, this is true. But let's say that we made this investment in the past, and then we do the evaluation today. So why, if we miss time, we have a problem? Anna, can you hear me?
I have no idea.
Wait, don't worry. Let's try to understand. So let's say that we do this evaluation today, okay? Anna, can you follow me? Yes?
Yeah.
And there are two things in this formula. Let me go back. There are two things, numerator and denominator. Do you know what I mean by numerator and denominator?
Yeah.
So what we fix if we do the evaluation today? Numerator or denominator?
Numerator.
Denominator.
Just a second. Sorry. I'm talking to Anna, please. Wait.
Denominator.
Denominator.
Anna, what you said, numerator, correct?
Yeah.
Okay, good. You are right. So, and then what is the problem there? That let's say that the denominator can be yesterday, or can be 1 year ago, or can be 100 years ago. Is this different if we consider different those times?
I think so.
And please tell me about this difference. What is different?
Maybe the value of money were different. For example.
Okay, let's make an example. Okay, let's say that this ratio is we have a ratio, no? We have numerator and denominator, correct? Okay, let's say that is 1.1. And what is the meaning of this 1.1?
Do you mean the value of numerator or HPR?
I'm talking about the first formula. What is, if it's 1.1, what we get? What is?
It means that there is a 10% increase between the initial value and the final
Okay,
value.
so Anna, back to you. Yeah, it's clear this. 1.1, it means that you invested 100, for example, and you get 110. Yes?
Yeah.
Yeah.
Okay. Now tell me what can change if we change the time. So because we fixed the ending value, okay? We know that the time is today. We will do this valuation today. Can you please tell me what can change if we change the denominator? So the time of the denominator, not the value, not the amount. It will be always 1.1. But what is the difference if we consider different times? So let's make an example.
I think the number will be less.
No, the number is always the same. We said it's always 1.1, but we consider different times. So one matter is if, for example, if we invested 2 days ago, another matter is if we invested 100 years ago. So what, in your opinion, is different? The result is always the same, but the time is different. So what, in your opinion, changes in your evaluation? Let me explain this better. So Anna, we said 1.1 means what? That we have she's gone. What happened? Okay, I switched to Nadia. Nadia, can you answer this question?
The question about what will be changed?
Yeah, what will be the change? You will get always the same result. It's always 1.1.
The result is 1.1, and the final value also doesn't change.
Yeah, the beginning value is always 100, and the ending value is always 110. So the result of this ratio is always 1.1. So if we consider different times, what is the difference between the different what is the difference between the evaluation time? So how we can assess this this investment if we change time?
If we change time, maybe any interest rate change will change because the amount of money doesn't change. So
it doesn't change. So Nadia, let me explain this better, because then I see that you are lost. Okay, let's say that how much is the inflation in Russia? We said
7.5.
7.
Yes.
I remember another number, but it doesn't matter. Okay, 7.5. Let's say that you make this money in 1 hour, or in 1 day, or in 100 years. So you get 10%. So we said 1.1. Okay.
Mm-hmm.
Does this changes? Does your evaluation of this investment change?
I doesn't understand, maybe. We have same.
Nadia, you have inflation in
Yes.
1 year of 7%, okay?
Yes.
And then if you get this money, 10% interest, in 1 day, or if you get this money, 10% interest in 100 years, is this different or not?
Yeah, different.
Yes or no?
Yes, yes.
Okay, so why we should consider time?
Because the value are different.
No, the values are the same. We said always, let me write it, okay? So it's 110 divided 100. Can you read it?
Yes.
Yes? So this is what we have on top. We are on top, we are final value, okay? And divided initial value. It's clear?
Mm-hmm.
So again, it's the result is always the same. So is always final value divided initial value. But what I'm trying to tell you is that one matter is if you make money 10%, you see this is 10%. Yes?
Yes.
If you make this money in 1 second, or if you make this money in 100 years. You are lost.
I doesn't understand what is the question.
Okay. My question is, what is the original question is, in this formula, where you can see a problem?
In this formula, there isn't time. Doesn't take into account time.
Okay, because time is important. Why?
As I understand, because of inflation, maybe.
Because, Nadia, let's say that you give me 100, okay?
Okay.
You lend me 100. I borrow from you 100. If I give you back this money, 100 plus 10, in 1 second, or if I give you this money in bank with plus 10%, in 6 months, is this different?
Yes, it will be different because the value of money are different in different periods of time.
Okay, so what you have to consider is the time in which you made this money, so 10%. One matter is if you made this money in 1 second, another matter is if you made this money in 6 months or in 1 year. Because in 1 year, is convenient or not, given the inflation in Russia? In 1 year, if you get this money, not immediately, but in 1 year, this will be good or bad for you?
Maybe it will be bad if we doesn't take into account time.
Okay, so the same result, 1.1, can be different because of time. Is this clear or not?
Yes, it's clear.
Okay, so let's go ahead. I hope that is clear for everyone. So we mentioned this. Can you see the second formula? This one?
Yes.
So it's the same, but minus 1. So that would be 0.1, correct? And then here you can consider the time, for example. And this is, sorry. And this is considers, again, the period in which you made this money. And then let me, can you see well the screen now?
We can.
Okay. And then your colleague before, he said, okay, one matter, the problem with this formula, I said at the beginning, is that it doesn't consider the variation. So it could be that the variation in the middle can be extreme or can be very little. And then you have this kind of things that can show you the risk. So for example, you have the coefficient of variation, the standard deviation, and so on. So I guess that you already know what is the standard deviation, correct?
Yes.
Okay, good. now there is something that is called the required rate of return. So what we said before, we said that we want, if we lend money, we want a return for this money that we lend. Yes?
Yeah, sure.
Okay. And then we said we want this money return for many reasons. And then we mentioned what is this? Blah. It's gone. Okay, so Leonid is gone as well. Kirill, what we mentioned before?
We mentioned before that as the in the first formula, we doesn't take into account the time value of
It's
money.
fine. Before the interruption, sorry. What we said that are the different components of interest.
Yeah, we have said that the interest have three components: the time value of money, the inflation, and the risk premium.
Very good. But can you see that your risk premium, your evaluation of inflation, and then also your evaluation of time is the same of your friends?
No, it's different.
Okay, that is different. So then you require an interest that depends on your evaluation. And in your opinion, in the market, why you see normally just one value?
Because the demand and the supply is just cross, and we have, I know, the law of the one price.
Okay, so this is the answer, the correct answer. So you have your time value, you have your assessment of risk and so on. But then normally you see just one price because you go to the market and you ask, for example, as an interest, you ask for 10%. And we said that this interest is composed by different components, okay? Different elements, we said. But then someone else is available to lend for less, I don't know, for 9%. Then and there would be someone else that is available to lend for 12% and so on. So there will be, as you said, there will be a range of offer, and then will be a range of demand of money and offer of money. And what is the price of money?
The price will be the list price was suggested by.
Yeah, but what is it, this list price? What is the price of money?
Interest.
Very good. So the interest. So you will have this, depending on how much money is offered and much money is requested, you will get an adjustment based on the prices. So you have the classical thing that is that is quantity and then price. Those two things. Is clear for everyone?
Yes, it is.
Good. So let's go back to the presentation. You have a required rate of returns, but then you have, a kind of range of problems. For example, because there are different rates available for different investments. And And do you know why?
Maybe because different assets have different risks, so we have
Yeah,
different
exactly. This is a good answer. Exactly. Different assets may have different risks. But also, we said that the risk is something that is not objective, but is subjective, correct? You are there, no? So it could be that this evaluation may change with time. So it could be that, for me, the risk of lending money to someone today is 3%, and tomorrow it would be 50%. Why? Because either this person is less reliable, or because maybe the environment is more risky, no? So if this guy lives in a country in which there are many problems, maybe I will ask from this guy more interest, because this guy operates in that country. It's clear what I mean? Hello?
Yes.
Okay. So anytime, if you have questions, you ask. And then also, there is something that is called spread. So when you see difference between returns, so it could, let's say that we talk about Italian bonds and German bonds. So I mean treasuries, for example. You know what treasury are? Government bonds.
Yes, we do.
Okay, so it could be that there is a this spread. So you know that between Italy and Germany, who is stronger as an economy?
Germany.
German.
So if you invest in German government bond, you will ask less or more interest?
Less.
Less. So there is this difference that between the interest that you get if you invest in, you buy Italian bonds, and the interest that you get if you invest in German bonds. This difference is called spread. Do you know that? Hello? Arina? Yes?
Yes. Yes.
Okay. And this spread may change as well. So it could be that yesterday was 3%, and today is 7%. And tomorrow can be 2%. Why? Because every moment on the market, there are different evaluations. There are different assessments about inflation, about the probability of default, about the time value, and so on. All these things that we said before may change second by second. So the required rate of return is not something simple to assess. There is, but it's what you see on the market. And what you see on the market, again, is something that changes from not only from day to day, but it could be from second to second. Is clear what I mean? Okay, good. And now let me show this example. This is all the example, but this shows you what happened in the past. Who is able to read the meaning of this table? Nick, can you try?
Now I can't see them, but I guess that
Just that I go switch back, okay?
there are different types of bonds. So
yes, and then let's wait. Different types of bonds. Okay, so this column.
Yes.
So what you can see here in terms of type of bonds?
I can see two types of government bonds. I'm not really sure what's the difference, but
Okay,
I
I
know
tell you, just for a second. This is 3 months.
3 months.
What is the meaning of 3 months?
So the time you hold them is 3 months.
No, it's not the time that you hold, the time that expire.
Yes.
And I tell you the difference. You can buy the bond when it's issued. You know the meaning of this issue of a bond?
Yes.
So you can buy this bond when it's issued. So can you explain to your friends what is the meaning of issued?
When the bond is officially printed, I know, issued.
Well, when the bond is sold on the market, okay?
Yes.
Good. And then you and this bond expires, we said, in 3 months, okay? Then also you have the possibility to buy this bond the day before the expiration. Yes?
Yes.
So in the first case, how much time you have to wait? And the second case, how much time you have to wait?
In the first case, the whole expiration period, and in the second case, only 1 day. So yes, it's different from
It's different,
expiration
you see.
period. Yes.
Okay, so not the time that you hold the bond, but the time that expires, okay?
Yeah.
That will tell you how much time you have this contract. The bond is a contract, a contract between you and the issuer. And then when you buy the bond, you give money, and then you enter in a contract. It's like when you go in the supermarket, you buy banana, no? Officially, you have a contract because you give money and you get bananas, okay? Clear?
Yes, it is.
And then also you can do something else. You can sell this contract to me.
Yes, I
If
can.
you sell the contract to me, then I buy it, and then you don't need to wait 3 months. You can you buy the bond today, and you sell it tomorrow, or you sell it after a second. It's clear what I mean?
Yes, it is.
And then I have the right to get this money from the American government, okay? You don't have this right anymore because you sold the contract to me.
Yes, I understand it.
Okay, good. Now let's go back to the presentation. Where is it? It's here. So this is 3 months, okay? So this is the expiration. Yes, we said it. How much time this contract lasts, okay?
Yes.
And then you have this government bond. Government bonds are more or less between I don't know, 7, 10, and 30 years long. So the contract is for this range of time, but normally you have benchmarks. And then when you refer to government bonds, you say, okay, my benchmark is the treasury that expires in 10 years. But this doesn't mean that you must take and hold this bond for 10 years. Is clear what I mean or not?
Yes, it is.
Okay, good. And then the benchmark. How do you fix the benchmark? Do you have an idea?
Is it the interest or is it some kind of, I don't know, interest at which I'm going to sell it or buy it?
No, I tell you this because you cannot get it. When you buy or sell things, because you said you buy, we said before, then you don't need to keep this bond for 10 years or for 3 months, correct? Yes?
Correct.
And then you need a reference security. A reference security is, we said, the contract, no? Because you have a contract when you buy bonds from someone else or from the issuer. So let's make this example. Let's say that you invest in a house. If you want to get back this money, can you do it in 1 second? If you want to sell it, you buy a house and then you want to sell it immediately. Can you do it?
Perhaps not. It will take some time to find a buyer.
Okay, that you need time, and then you need many people interested in this house, no? Otherwise, it will be difficult because maybe you will find the people, but they will not pay what you want. Okay. So normally the benchmark is the reference bond, and the reference bond is the most liquid one. It's clear what I mean by liquidity. We will see it later, but bear in mind that when we talk about bonds, normally we talk about the benchmark and we talk about a very liquid bond that belongs to that class. So we will have liquid bonds in 3 months in the category of 3 months. Then we have liquid bonds that are in category 10 years and so on. It's clear what I mean?
Yes.
And then why liquidity is important?
Because if at some point you want to sell it, but you don't have any buyers, you are not able to sell it.
Good. So we want liquid goods. When we invest, we want liquidity. Liquidity is very important. Okay. So let's go back to the presentation, and then we have 3 months, then longer term bonds. And do you know what is this?
Yes, it's corporate bonds, so it's bonds issued by companies. And
Correct.
as I remember, AAA corporate bonds, they are most secure bonds, so with low risk. And
Low risk of what? Sorry. What lower risk of what?
So they are less riskier than, for example, BAA corporate bonds.
No. Please follow. You said lower risk, okay?
Yes.
And lower risk of what? Because we made an example before with your colleague.
Lower risk of default, I
Default.
guess.
Okay, good. Default. That is the thing. Lower risk or default. And then go back. And then you have BAA. And you said lower. This is lower risk and this is higher risk. Now, can you say something about this? Just recall.
So the high is the risk of default, The high is the interest rate.
Okay, so we can explain why this is bigger than this, okay? Yes?
Yes.
And why this is smaller than this?
Because we assume that the government has higher chances of default in the longer period.
Okay, because in the long run, we don't know what is going to happen. The longer the time, and the longer the bigger is the risk.
Yes.
Because it's what we made, the example that we made together with Nadia. Nadia, you remember when we said we have an investment, but one matter is an investment for 1 second, another matter is an investment for 100 years. You remember, Nadia?
Yes.
Okay, now it's clear, correct? Good. Okay, so let's go ahead, and then can you explain this as well?
So something changed in the economic situation, but it presumably changed only in the short run. So in the long run, everything is pretty the same.
Okay, and why, in your opinion, we have almost the same values here and a big change here?
Maybe because of some kind of short run shock, maybe some short, well, assumed being short crisis or something
Okay,
like that.
because if we have an investment, okay, for 30 years, no, and then we have a shock that doesn't change the ability of the government in the long run to pay, or the ability of the company to pay, it doesn't matter, no, because we don't care. But then if the economy of a country is completely changing because of shock, then the hit, the changes will be more on the longer run, okay? So you have short term, and then interest rates are affected on the short term if you have a shock on the short term, and the opposite. If you have a shock that is affecting the country or the company in the longer term, you will have this kind of change more on that side. But then, in terms of risk, we said that before that if we invest on 3 months, we have less risk, correct? Do you agree?
Yes.
In your opinion, who has lost more in this situation, in this situation that is here?
Well, short run investors lost more.
Exactly. So at the end of the day, we said, okay, it's safer to invest in short 3 months bill, correct? This is the less risky asset, correct?
Yes.
But apparently, because it can be that in reality you are exposed to a short-term shock, and then you think that you are safe, but you are not. You are the most exposed investor on the market. It's clear what you mean?
Yes, it's clear, but it's the risk of other sort, so it's really hard to predict and somehow measure?
Well, task for whoever is investing is to measure and to predict things. Of course, you can make mistakes because no one is God, no? But the idea is that you have to think ahead and you value the risks, and then based on that, you do the investments. But again, what I wanted to show you is that what seems to be a safe investment can be a risk investment. Okay. Okay, good. So let's go ahead. Then we have something that is called risk-free rate, and we put before real because real is not against fantastic, but real is to distinguish between nominal interest rates. Otabek, what is the difference between nominal and real interest rates? Do you know it?
Yes, of course.
Tell me.
Nominal interest rate does not consider inflation,
Correct.
and
Correct.
the real one is just adjusted for inflation.
Okay, good. So then depends. This evaluation depends on two things: subjective things like time preference and is what we said before, and then all the things that we said before, and then you have objective things like, for example, the set of available opportunities. So you have to you can ask a higher or less smaller interest rate depending on the business that you run, depending on the country in which you invest and so on. For example, in your opinion, which country is growing faster in the world? Anton?
I don't know exactly, but maybe the UK.
What?
United Kingdom.
I don't think so. Otabek?
Yeah.
So which country?
Could you please repeat the question? Yeah.
Anton, can you please repeat the question?
Oh, I'll try. Otabek, in your opinion, what Europe, what country in Europe?
Not in Europe. In the world.
Not in Europe.
In the world.
In the world, is developing in the fastest way.
I have no idea. It should be some kind of an Asian country, I guess. I don't know exactly.
So just tell me one.
So let's say that it's Singapore.
Okay, so as an assignment, you check this thing. Okay, you buy region, you check what is the country that is growing faster. Now, let's say that Otabek is right, okay, that Singapore is the fastest country. Sorry?
Yeah, you won't believe it, but Wikipedia says that Libya has showed 173% of real GDP growth in 2021. So it's actually Africa.
Yeah, that is Africa, but keep Libya aside because there was a war and there is still a war there. So let's talk about, Nick, I'm trying to explain this now. Let's say that your country is very developed, no? And then that means that you start from basis. It's clear what I mean? So you have, I don't know, infrastructure, university, whatever, no?
Okay.
And then let's say that your country grows by 5%. But if you have nothing, because everything has been destroyed, like in Libya, because there was a war, there is still a war. Just the fact that you build something is distorting the statistics. Why? Because what you do a ratio in order to check in order to assess the growth. No, you have a numerator and denominator. What you have denominator?
When we calculate real GDP.
Yes.
We should divide nominal GDP by level of prices, which is inflation.
Okay, let's talk about real GDP. That you have real GDP, a time series of real GDP. So you don't have inflation. Let's say that inflation is 0. What you have on numerator and what you have on the denominator?
Denominator, what is 1?
Why is the 1? Whatever.
Because we have nothing to add to. I mean, so 1 plus 0 is 1. So that's the reason why it's 1.
No, this is wrong. You have something like this. I show you. It's what I mentioned before. You have this thing. And then when you want to do the return, the yield, the growth, you do -1. So what you have on the denominator and what you have on the numerator. If we talk about GDP.
Could you please repeat the question? I mean, I don't understand.
If we talk about GDP.
If we talk about real GDP, yeah?
We say that there is no inflation, okay? So real GDP and nominal GDP is the same. So this makes things easier. So when you want to measure the change in the GDP, what you have to do?
Nominal GDP divided by some level of prices, CPI or deflator.
No, we said there is no problem. There is no inflation. The prices are constant.
If prices are constant, then that value in the denominator is going to be 1.
But why 1?
Because I don't know how to explain it. It's kind of obvious. I don't know how to explain it.
But what you say that is obvious is obviously wrong.
Rebecca is talking about deflator, and if the inflation is
no
0.
No, there is no inflation. We said there is no inflation. Don't talk about inflation or deflation or whatever. There is no inflation. Prices are constant.
Okay, in that case, we just divide nominal and real GDP, which is the same, by the value of the last year.
What you do is to take the GDP of this year and you divide by the GDP of last year.
Yes.
Okay, so ending, so this year and beginning last year, okay? That's clear?
It
and
is.
this thing can be zero. If you have a war and everything is destroyed, this thing can be zero or can be close to zero. It's clear what I mean?
Yes, it's clear. That's why Libya has such an I don't know,
No, you have a
define
very
rate.
low denominator. It's not zero, of course, because we know that, but it's not zero, of course. But it's very low for the reason why there is a war there. So that's why we cannot consider this kind of statistics for a country that is in that condition, okay? So when you do this kind of comparison, please consider, like every time, you have to compare apples with apples. Do you know what I mean by that? Okay, so don't compare a country that is in a war with a country that is in peace. Yes?
Yes.
Okay, good. So then let's go back to the initial point. So we said that we want to invest in countries that maybe have a different developing pattern. Why that? Because if we invest in a country that is developing very fast, in your opinion, this will make your investment more rewarding or not?
If we invest in underdeveloped country, do you mean this one?
In a country that is developing very fast, you will get more money, less money?
Yeah.
What is your opinion?
We're going to get higher returns on investment.
So exactly. So what you can expect from a country that is developing faster is what you can expect is that, like in a company that is growing faster, no? One matter is if you invest in a company that is growing very little or is stationary. Another matter is when you invest in a company that is growing very fast. Okay? But then, what is the other side of this kind of investment? What is the risky side of this investment? Let's say that we have a country that is growing very fast and a country that doesn't grow very fast. What can be the risk?
Well, Libya can just go into war once again, and all our funds will be lost.
Well, let's take away Libya because we said that there is a war. Let's talk about, I don't know, two other countries, Singapore and then, I don't know, whatever, Italy, Spain, France, England. What would be the risk?
So there is different source of growth. For example,
yeah, we said that we are growing differently, with a different pace, no?
Yeah, for example, if you take the overall, if you take, for example, overall source of growth, and if it's if it is composed of that in its most part, the investment is going to be more risky because the risk of default is higher in this kind of companies or countries.
Where is higher?
The risk of default is higher in countries or companies that have higher debt, more debt overall.
Let's say that
proportion to some real assets.
let's say that in Singapore and UK have the same debt. So which one is risky?
The one that has higher proportion overall. For example, if it has some value, and
let's say that they have the same proportion. Same proportion. Let's say that they have the same proportion.
Same proportion. Then
sorry,
it more depends on some other factors as well.
Proportion is a ratio. Proportion between what?
Proportion of that to value, for example.
What you have? You have a ratio between what?
Between debt and equity, for example.
No, I'm talking about countries.
Okay. If it's country, then some real assets. I don't know, as a source of investment.
No, for countries, the equity, for companies, you are right. But for countries, the equity is GDP.
Mm-hmm.
So, to conclude, because the time is over, I just got, who sent this message?
Are there some other slides as well?
No, what you have to understand is that what you said before, Otabek. If you remember, before you said something regarding the fact that there is a variation in the time series. And then I told you that is the risk, and then you assess it with the standard deviation, whatever, no? And then if the variation is high, then you have more risk. This is just an example, okay? Okay, so I guess that we have done, and then we will meet, when is next time? Let me check it.
Next week, we have one seminar.
Okay, who is going to teach you this seminar? Do you know it?
I don't know.
You have no clue. Okay, then you will tell me about this. Okay, one thing I just add now to the chat my email address. Okay, is this one.
Can you please send us the presentation? I'll send.
I said it many times. Yes, I will do it. I will send it to Nadia. Okay.
Okay.
Next week we have one lecture. I look at the timetable.
We have one lecture on Tuesday and a seminar on Thursday.
Yeah.
With you.
I see. Agree.
So when we will meet again?
Tuesday.
The 13th, no?
Yes, exactly.
Okay. Okay. So I think that that's all, and then I wish you a nice evening. Bye bye.
Thank you. Goodbye.
Bye.
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 Goodbye.